Hey, Brad Niccum, Nest Mortgage Group here. Just want to say happy Monday. I want to touch on a couple things that are changing in the lending rules or the lending world here. One of them is going to impact our buyers. It's a new loan level price adjustment that's being added to the debt to income ratio for all Fannie Mae and Freddie Mac loans. Most of you know there's loan level price adjustments for several factors. The higher the credit score, the lower the loan level price adjustment. The larger the down payment, the lower the loan pricing, and also the larger the loan amount, the less those loan level price adjustments affect. That's how one person with a 740 credit score and 50% down on a $700,000 loan amount is going to have a better interest rate than, say, a 680 credit score buyer putting down 3% on a $100,000 loan amount. Well, the new loan level price adjustment will go into effect in May, and this fourth one is for debt to income ratios. So now they're going to take into account the debt to income ratio of the borrower and add another price adjustment based on how bad their DTI is. So any borrower with a back end debt to income ratio over 40% is now going to have another price adjustment. So it's going to make that higher debt ratio customer have a little bit higher interest rate and a little bit harder to get pre-approved than the person with the lower debt to income ratio. So let's say you've got a 740 credit score putting down 20% on 400, and the back end ratio is only a 35%. Today, say they're at 6.5 with no points. If you compare that to a borrower with a 680 credit score putting down 5% on that $100,000 loan, and they have a 45% back end debt ratio, they could be sitting at 7.25. If you'd like a better breakdown of how loan level price adjustments work and what the breakdowns and levels are, just give me a call. I'd love to explain them to you. Another change that was just announced by Freddie Mac is a new seasoning requirement for cash out. This really doesn't affect a lot of our regular first-time home buyers or regular home buyers, but it will affect our investment buyers. So right now, you know that an investment buyer can buy a house, say he pays cash for it, does a rehab on it, and 6 months after owning it, he could do a cash out refinance and pull the money out that he invested into that house. Now, he's going to have to wait 12 months. So that new seasoning rule is going to take that out a little bit longer to be able to do a cash out refinance. Interest rates have taken a little bit of drop over the last few days. We did have the CPI showing that inflation's continuing to fall. This is a good week. Mortgage applications come out on Wednesday. New home sales, GDP, and jobless claims come out on Thursday. And Friday, we will get the personal consumer index, PCE, that comes out. And that's going to show us another level of inflation. So it could have a really positive effect on interest rates. We do believe that it's going to come out a little higher month over month, but should be lower year over year and show that inflation is continuing to go down. So underwriting time still 24 hours. Conditions clearing still 24 hours as well. Closing loans well inside of 30 days, and appraisal waivers in that 10 to 15. Also pre-approval 7 days a week. Pretty much whenever you call. It takes about an hour to get those done. So if you've got somebody that needs to be pre-approved, give us a call. And I hope you have a great week this week.